I'm John A.G. This is the Collapse Files, documentary analysis of monetary system failures. We don't predict, we reveal patterns. Let's begin. In 1988, the United States government spent $290 billion on defense, protecting its borders, maintaining the world's most powerful military, and projecting force globally. That same year, interest expense on the national debt was $214 billion, representing 74% of defense spending. The government could defend the nation and still have fiscal capacity remaining. Interest was a line item, significant but manageable, well below the cost of maintaining security and global influence. Today, in fiscal year 2025, the United States government will pay approximately $1.14 trillion in interest on the national debt. Defense spending, including all military operations, personnel, equipment, and veterans benefits, totals $874 billion. For the first time in American peacetime history, interest expense exceeds defense spending by 30%. The government now pays more to service past borrowing than to maintain current security. This crossing point, where debt service surpasses defense, has occurred in only a handful of nations throughout history, and in every case, it marked the beginning of the end of that nation's capacity to project power, maintain sovereignty, or avoid fiscal crisis. When the cost of servicing accumulated debt exceeds the cost of defending the nation, and when this occurs not during wartime emergency, but during a period of relative peace and prosperity, what does history reveal about how long such a configuration can persist before either the debt becomes unpayable or the defense becomes unfundable? For most of history, governments faced a natural constraint. The cost of servicing debt competed directly with maintaining the military necessary for survival. A king that devoted too much revenue to creditors couldn't pay soldiers, leading to military weakness and conquest. This created discipline. Debt could not expand indefinitely because defense could not be sacrificed. Ancient Rome spent 70 to 80% of imperial revenue on the legions. Interest on debt was minimal. The military conquered territories, secured borders, and collected taxes, generating the revenue that sustained it. Rome never reached a condition where debt service competed with military funding because the military itself generated revenue through conquest. When Rome experienced fiscal stress in the 3rd and 4th centuries, military expenditures remained the priority. But the empire was no longer conquering. Revenue stalled while expenses rose. The response was currency debasement, reducing silver content in coins to stretch metal across more nominal units. This preserved military capacity temporarily, but destroyed currency credibility, creating the hyperinflation that made the empire ungovernable. Rome chose to default through inflation rather than disband the legions. Medieval European kingdoms followed similar patterns. Military expenditure consumed 60 to 80% of royal revenue. Kings borrowed to finance wars, but lenders refused credit beyond what military success could repay. The constraint was self-enforcing. Military funding took priority, limiting debt accumulation. The Spanish Empire demonstrated what happens when debt service begins competing with military funding. Spain controlled the world's richest silver mines, but faced continuous wars against the Netherlands, France, England, and the Ottoman Empire. Expenses exceeded even treasure fleet revenue. By the 1550s, debt service consumed increasing revenue shares. The Spanish crown defaulted 6 times between 1557 and 1647, each time when debt obligations threatened to crowd out military funding. After each default, Spain could continue wars because armies remained intact and silver continued flowing. But each default reduced future borrowing capacity. By the 1640s, Spanish military power had declined substantially. Even vast wealth could not sustain indefinite deficits once debt service consumed defense revenue. The British Empire created a different model after the Napoleonic Wars. British debt reached 260% of GDP. Interest consumed 40% of revenue by 1815. Yet Britain funded the forces that defeated Napoleon. The mechanism was tax capacity extracting revenue from Industrial Revolution growth, providing funds for both debt service and military expenditure. But even Britain faced limits. The debt ratio declined from 260% to 30% over a century through GDP growth, outpacing debt growth and modest inflation eroding real value. Had growth not accelerated through industrialization, Britain would have faced the same trade-off that crushed Spain. The United States maintained low debt ratios through most of its history. Federal interest rarely exceeded 10% of revenue during peacetime from 1870 through 1940, while military consumed 20 to 40%. World War II pushed debt to 120% of GDP, but interest rates were capped at 2.5% through Fed cooperation. Post-war growth averaged 4% annually through the 1950s and 1960s. Financial repression, keeping interest low plus rapid growth, allowed debt ratios to decline to 30% by 1980. Interest remained well below military spending. The historical pattern was consistent. Nations could sustain high debt temporarily during wars, but sustained ratios required growth, outpacing debt, or financial repression, suppressing costs. When debt service approached or exceeded military expenditure, it signaled unsustainable borrowing, the government prioritizing past obligations over current security, indicating fiscal exhaustion and approaching crisis. The modern condition where interest exceeds defense emerged through policy choices that progressively removed historical constraints on debt accumulation. The Federal Reserve Treasury Accord of 1951 formally ended the Fed's commitment to cap rates, theoretically restoring market pricing. But the precedent was established. When necessary, the Fed would intervene to ensure manageable borrowing costs. The 1970s broke the benign pattern. Gold window closure in 1971 removed the final external constraint. Inflation surged to double digits. By 1981, the government paid over 15% on new borrowing. Interest expense rose from $52 billion in 1979 to $129 billion in 1982, despite modest debt growth, purely from rate increases. This created fiscal crisis. Interest consumed a little known less than 7% of revenue, approaching the 24% defense consumed. Fed Chairman Paul Volcker raised rates above 20% to break inflation, accepting severe recession. Inflation fell from 13% to 3% by 1983. Interest rates declined from peaks. The crisis passed. The 2008 financial crisis marked the decisive shift. Federal debt exploded from 67% of GDP to 100% by 2012 as trillion-dollar deficits financed bailouts and stimulus. This doubling would historically have caused interest expense to surge, but it didn't. The Fed implemented zero rates and quantitative easing that suppressed yields artificially. The Fed cut rates to zero and purchased over $5 trillion in treasuries, becoming the dominant buyer. The 10-year yield fell to 1.5% by 2012 and to 0.5% during the pandemic. Average interest cost declined from 5% to 2% despite debt doubling. This suppression prevented the debt service trade-off from materializing. In 2015, interest was $223 billion, only 6% of revenue, while defense was $560 billion, or 15%. Interest remained well below defense because rates were held near zero. The COVID pandemic accelerated all trends. Federal borrowing exceeded $4 trillion in 2020 and $2 trillion in 2021. Debt surged from 108% to 133% of GDP. The Fed expanded QE to unlimited scale, purchasing 75% of new issuance. The 10-year yield fell to 0.5%, and average cost fell below 2%. Despite $28 trillion in debt by 2021, interest was only $413 billion, less than defense spending of $753 billion. The ratio was only 55%. But this was artificial, sustained by the Fed suppressing yields to levels bearing no relationship to risk. When inflation surged to 9% in 2022, the illusion shattered. The Fed raised rates from 0 to 5.5% in 18 months and ended QE. Treasury yields surged, the 10-year rising from 1.5% to 4.7%. Average interest cost began rising from 2% toward market levels. The effect was mechanical. In fiscal 2020, 2% average cost on $27 trillion debt generated $540 billion interest. By fiscal 2024, 3.3% on $35 trillion generated $880 billion, a 63% increase in 4 years. Average cost continues rising as old, low-rate debt matures and refinances at current 4 to 5% rates. Projections show average cost reaching 3.8% by 2026, implying interest exceeding $1.2 trillion on projected $38 trillion debt. Defense remained relatively stable, $753 billion in 2021, $874 billion in 2025. The ratio of interest to defense rose sharply, from 55% in 2021 to 100% in 2024 to projected 130% in 2025. The crossing occurred in fiscal 2025, when interest of $1.14 trillion exceeded defense of $874 billion for the first time. This wasn't from reduced military spending. Defense is near historical highs. It was the mathematical certainty that $35 trillion debt at 3.3% generates more interest than $874 billion defense spending. The crossing represents decades of accumulation masked by suppressed rates. Once rates normalized toward market levels, the accumulated debt revealed its true cost. The government now pays over $1 trillion to service past borrowing. Before funding current defense, the priority has inverted, revealing fiscal capacity exhausted. The quantitative evidence of the interest-defense crossover reveals not just a single-year anomaly, but a structural deterioration that will intensify annually unless interest rates fall dramatically or debt growth reverses, neither of which appears plausible given current fiscal and monetary dynamics. Federal government interest expense in fiscal year 2025 is projected to reach $143 trillion based on current debt levels and interest rate trajectory. This represents 19.4% of projected federal revenue of $5.9 trillion. To contextualize this share, consider that in 1988, interest expense of $214 billion represented 14.4% of revenue, which was then considered elevated and concerning. The current 19.4% represents the highest peacetime share in American history, exceeded only briefly during post-World War II debt workdowns in the late 1940s, when debt ratios were 120% of GDP, but interest rates were artificially capped at 2.5%. Defense spending in fiscal 2025 totals $874 billion, representing 14.8% of federal revenue. This includes $842 billion for the Department of Defense base budget and operations, plus $32 billion for defense-related activities in Department of Energy and other agencies. Veterans Affairs spending of $301 billion is sometimes included in defense-related spending, which would bring the combined total to $1.175 trillion, essentially matching interest expense. But using the traditional DoD-focused definition, defense is $874 billion, creating the 130% ratio, where interest exceeds defense by $269 billion. The trajectory of average interest cost on federal debt explains why expense has surged despite relatively modest debt growth recently. In fiscal 2020, average interest cost was 2.0% on $27.7 trillion in debt outstanding, generating $554 billion in interest expense. By fiscal 2024, average cost reached 3.3% on $35.3 trillion, generating $880 billion. The debt increased 27%, while interest expense increased 59%. The differential is explained entirely by the 130 basis point rise in average cost. Projecting forward, if average cost reaches 3.8% in 2026 as old low-rate debt matures and refinances at current market rates, interest expense would exceed $1.3 trillion on projected debt of $37 trillion, representing a 135% increase from 2020 levels, while debt increased only 33%. The maturity schedule of federal debt shows why average cost will continue rising inexorably. Approximately $9 trillion in Treasury securities mature over the next 3 years and must be refinanced. Much of this debt was issued during 2020-2021 at yields of 0.5 to 2% when the Fed was implementing unlimited QE. This debt will refinance at current market rates of 4 to 5%, doubling or tripling the interest cost on those specific tranches. Each quarter as another $500 to $700 billion matures, the blended average cost on total debt rises as low-rate obligations are replaced with high-rate obligations. Defense spending trajectory shows much slower growth than interest expense. From fiscal 2020 to 2025, defense increased from $725 billion to $864 billion, an increase of $149 billion, or 20.5% over 5 years. This barely keeps pace with inflation of approximately 18% cumulative over the same period, meaning real defense spending is essentially flat. Meanwhile, interest expense rose from $554 billion to $1,143 trillion, an increase of $589 billion, or 106%. The ratio of interest to defense rose from 76% in 2020 to 131% in 2025. Extending this trend, if interest continues rising toward $1.4 trillion by 2027, while defense grows 3% annually to roughly $925 billion, the ratio would reach 151%. Interest expense exceeding defense by over 50%. The comparison to other major budget categories reveals how interest has become the dominant fiscal constraint. Social Security spending in fiscal 2025 is approximately $1.35 trillion, still exceeding interest, but not by much, only 18% more. Medicare spending is $848 billion, less than interest for the first time. Medicaid is $616 billion. All other discretionary spending combined, State Department, Justice, Transportation, Education, NASA, everything, totals approximately $900 billion. Interest expense now exceeds Medicare, Medicaid, and is approaching Social Security. Within 5 years at current trajectories, interest could be the single largest federal budget item, exceeding even Social Security. The international comparison shows the U.S. is not alone in experiencing this crossover, but is among the first major powers to reach it outside of debt crisis conditions. Japan has paid more in debt service than defense for over a decade, but Japanese defense spending is constitutionally constrained to roughly 1% of GDP, while debt is 260% of GDP and interest costs are approximately 1.3% due to Bank of Japan yield curve control capping rates at 1%. Italy's interest expense exceeds defense spending, but Italy has debt at 145% of GDP and has faced sovereign debt crisis conditions requiring ECB intervention. The U.S. reaching this crossover with debt at 123% of GDP and without being in formal crisis conditions indicates how rapidly fiscal deterioration can occur when accumulated debt meets normalized interest rates. The revenue constraint shows why the crossover creates fiscal crisis potential. Total federal revenue in fiscal 2025 is projected at $5.9 trillion. Interest expense of $143 trillion consumes 19.4% before any government services are funded. Defense at $874 billion consumes another 14.8%. Social Security at $1.35 trillion consumes 22.9%. Medicare at $848 billion consumes 14.4%. These four categories alone total $4.215 trillion, representing 71.4% of revenue. Only $1.85 trillion remains for everything else: Medicaid, veterans benefits, education, infrastructure, justice system, federal employee salaries, and all other discretionary and mandatory programs. The debt service coverage ratio shows fiscal sustainability deteriorating. A simple metric is the ratio of revenue to interest expense, how many times over the government could pay interest from revenue. In 1988, revenue of $909 billion covered interest of $214 billion, or 4.2 times. In 2000, revenue of $2.0 trillion covered interest of $223 billion, 9.0 times. In 2020, revenue of $3.4 trillion covered interest of $554 billion, 6.1 times. In 2025, revenue of $5.9 trillion covers interest of $143 trillion, only 5.2 times. The coverage has declined by 43% from the 2000 peak, indicating that interest expense is consuming revenue at a faster rate than revenue is growing. The primary deficit, the budget deficit excluding interest expense, reveals that the government cannot cover interest from tax revenue without borrowing. In fiscal 2025, the total deficit is projected at $1.9 trillion. Interest expense is $143 trillion. This means the primary deficit, spending on everything other than interest minus revenue, is approximately $757 billion. The government is borrowing $757 billion just to fund operations before paying interest, then borrowing another $143 trillion to pay interest. Approximately 60% of new borrowing is to pay interest on old borrowing, a classic debt spiral dynamic. Historical comparisons to other nations at similar crossover points are sobering. Italy reached the point where interest exceeded defense in the early 1990s, when debt was 120% of GDP and interest rates were 12 to 14%. Interest expense consumed over 12% of GDP and 25% of government revenue. The Italian government was forced to implement harsh austerity, raise taxes dramatically, and eventually required European Central Bank intervention to avoid default. Italy never fully recovered. Debt remained above 130%, and the economy experienced 2 lost decades of minimal growth. Greece reached even more extreme ratios during the 2010-2012 crisis, when interest exceeded 7% of GDP, and the government required European and IMF bailouts exceeding $250 billion to avoid outright default. The U.S. situation differs from Italy or Greece because the dollar is the global reserve currency, and the Federal Reserve can theoretically create unlimited money to purchase treasuries. But this capacity has already been tested through $5 trillion in QE that contributed to 9% inflation, forcing reversal. The crossing point, where interest exceeds defense, sends signals about fiscal sustainability and policy constraints that extend beyond budget arithmetic. The first signal is that discretionary spending has become subordinated to mandatory spending and interest. In fiscal 2025, mandatory programs like Social Security, Medicare, and Medicaid total $2.8 trillion. Interest is $143 trillion, totaling $3.943 trillion against revenue of $5.9 trillion. This leaves $1.96 trillion for all discretionary spending. With defense at $874 billion, only $1.1 trillion remains for all non-defense discretionary: education, infrastructure, justice, everything Congress appropriates annually. The government has lost control of the majority of the budget. Obligated by law for entitlements, by contract for interest, defense cannot be cut dramatically without security consequences. The remaining $1.1 trillion is only 14% of total budget and shrinking as interest rises. Future deficit reduction must come from cuts to already squeezed discretionary programs or politically impossible entitlement reforms. Interest cannot be cut without defaulting. Social Security and Medicare require legislative changes no Congress will pass. Defense cuts are possible, but limited by geopolitical realities. cutting from $874 billion to $700 billion saves $174 billion, but reduces capacity substantially while China expands and conflicts persist. The fiscal arithmetic offers no politically viable path to deficit reduction, suggesting deficits will persist and debt will grow, worsening the problem. The second signal is monetary policy constrained by fiscal dominance. Historically, central banks set rates based on economic conditions and fiscal policy adjusted. Currently, the government must borrow $2 trillion annually regardless of rates due to structural deficits. If the Fed raises rates to combat inflation, it increases interest expense, worsening deficits and requiring more borrowing that could be inflationary. If the Fed cuts rates or restarts QE to suppress costs, it risks stoking inflation. The Fed raised rates to 5.25%, succeeding in reducing inflation from 9% to 4%, but rate increases caused interest expense to surge from $540 billion to $1,143 trillion, adding over $600 billion to deficits. The additional borrowing partially offset the disinflationary effect. The Fed's options are constrained by fiscal dynamics in ways not seen in prior cycles. The third signal appears in Treasury auction dynamics. Foreign holdings declined from 34% of total debt in 2011 to 28% in 2024. Foreign holdings peaked at $7.7 trillion in 2021 and fell to $7.3 trillion, despite total debt growing from $28 trillion to $35 trillion. Foreign buyers aren't absorbing proportional shares, requiring domestic buyers or the Fed to fill the gap. Recent auctions show weaker demand, lower bid-to-cover ratios, higher yields to clear, primary dealers forced to take larger positions, markets price increasing supply, meeting constrained demand. Loss of foreign demand is concerning because foreign central banks historically bought for reserve purposes regardless of yield. If they're diversifying toward euros, yuan, or gold, that stable demand disappears. The fourth signal is deficit composition. In fiscal 2025, the $1.9 trillion deficit consists of $757 billion primary deficit plus $143 trillion interest. This means 60% of new borrowing pays interest on previous borrowing, a debt spiral dynamic. Borrowing to pay interest is not sustainable indefinitely. Resolution requires growth outpacing debt, inflation eroding real value, or default eliminating obligations. Continued borrowing to pay interest cannot persist. All signals converge on the interpretation that the interest defense crossover is structural and will persist and intensify, given current trajectories, debt levels, and political constraints. The crossover signals the U.S. has entered a fiscal configuration historically associated with crisis, where debt service consumes so much revenue that core functions, including defense, face constraints. Resolution mechanisms, growth, austerity, inflation, or default, all involve substantial pain. Historical precedent for nations reaching the point where debt service exceeds defense spending provides clear patterns for how such configurations unfold and ultimately resolve, none of which suggest smooth or painless adjustment. The Habsburg Empire in the 16th and 17th centuries faced rising debt service costs from continuous wars financed through borrowing from Genoese and German bankers. By the 1550s, interest payments consumed approximately 40% of Spanish crown revenue, while military expenditures consumed another 50%, leaving only 10% for administration, court, and other functions. The empire defaulted in 1557, restructuring debts and reducing interest obligations, but wars continued, requiring new borrowing, and the empire defaulted again in 1575, 1596, 1607, 1627, and 1647. Each default provided temporary relief by reducing interest costs, but each also raised future borrowing costs and reduced borrowing capacity. Eventually, continuous defaults and rising debt service relative to revenue contributed to Spanish decline. The empire could not compete militarily with rivals who had more sustainable finances. The British Empire in the early 19th century faced debt ratios exceeding 260% of GDP following the Napoleonic Wars. Interest expense consumed approximately 40% of government revenues, while military spending consumed another 30%. The burden was managed through a combination of mechanisms. Economic growth from the Industrial Revolution raised revenue faster than debt grew, allowing the debt ratio to decline from 260% to 30% over a century without explicit repayment. Additionally, the empire ran budget surpluses for decades, devoting tax revenue to debt reduction. Finally, modest inflation of 1% to 2% annually eroded real debt value over time. The resolution took 100 years and required unique circumstances: industrialization creating unprecedented growth, global empire providing revenue, and political consensus supporting austerity and surpluses. These conditions cannot be assumed to apply to the current U.S. situation. Italy in the 1990s reached a point where debt service exceeded defense and approached crisis. Government debt reached 120% of GDP, and interest rates were 12 to 14%, creating interest expense exceeding 12% of GDP and 25% of government revenue. Italy faced two options: default, which would have triggered financial crisis and potentially forced euro exit, or implement harsh austerity to demonstrate fiscal credibility and allow interest rates to fall. Italy chose austerity, dramatic spending cuts, pension reforms, and tax increases that produced budget surpluses for several years. The European Central Bank also intervened by purchasing Italian bonds and eventually implementing policies like OMT that capped yields. The combination of austerity and central bank intervention reduced interest costs and stabilized debt ratios. But the cost was severe: economic stagnation, rising unemployment, and political instability that persists. Italy never returned to robust growth, and debt remains above 140% of GDP 30 years later. Greece in 2010-2012 faced even more extreme conditions where interest expense reached 7% of GDP while the economy was contracting. Greece could not borrow in markets at any rate and required European Union and IMF bailouts exceeding $250 billion. The bailouts came with conditions: pension cuts, wage cuts, tax increases, and privatization of state assets. The economy contracted 25% from 2010 to 2016. Unemployment exceeded 27%. Hundreds of thousands of young people emigrated. The crisis destroyed Greek living standards for a generation. Greece avoided outright default only through continuous official sector support and by accepting depression-level economic contraction. For the United States, several potential paths exist, none attractive. The first option is economic growth acceleration to outpace debt growth. If nominal GDP grew at 5% annually, 3% real plus 2% inflation, while debt grew at 4%, the debt to GDP ratio would stabilize and eventually decline. Revenue would grow proportionally to GDP, providing funds to cover interest expense without increasing other taxes or cutting spending. This is the optimistic scenario, but requires sustained growth at rates not seen since the 1990s. Current growth is approximately 2.5% real, 2.5% inflation, totaling 5% nominal. But debt is growing faster, approximately 6 to 7% annually, including accumulating interest. For growth to outpace debt would require either accelerating to 7% nominal GDP growth or reducing deficit spending to slow debt growth to 4%. Neither appears likely given structural forces, demographics, productivity trends, and political gridlock. The second option is fiscal consolidation through spending cuts or tax increases totaling approximately $1.9 trillion annually, the current deficit. This would require cutting spending by 25% or raising taxes by 35% or some combination. Such consolidation would almost certainly trigger recession as government spending supports approximately 18% of GDP directly and more through multiplier effects. Tax increases would reduce private consumption and investment. The recession would reduce tax revenue, partially offsetting the consolidation and requiring even more cuts or increases. The political system shows no capacity for such adjustment. Attempts at modest deficit reduction through sequestration in 2013 triggered political crisis, and current polarization makes compromise on cuts or increases virtually impossible. The third option is financial repression, policies that force interest rates below the rate of inflation, allowing real debt value to erode over time. This would require the Federal Reserve to cap Treasury yields through unlimited purchases or regulatory changes forcing banks and pensions to hold treasuries regardless of yield. Japan has implemented such policies through yield curve control, and the U.S. used similar approaches during and after World War II. The effect is to transfer wealth from savers to the government. Savers receive nominal interest payments, but lose purchasing power through inflation exceeding interest rates. If maintained for a decade, financial repression at 2 to 3% negative real rates could reduce debt to GDP ratios by 20 to 30 percentage points. But the cost is economic distortion, misallocation of capital, and destruction of savings that funds retirement and investment. The fourth option is inflation above current levels, perhaps 5 to 7% sustained for a decade. This would erode real debt value substantially. If debt is $35 trillion and inflation averages 6% for 10 years, the real value falls to roughly $19 trillion in constant dollars, nearly a 50% reduction. Government revenue would rise with nominal GDP, but debt service would rise much more slowly as existing bonds pay fixed nominal coupons that lose value in real terms. This is implicit default, honoring nominal obligations while destroying real value. The cost is borne by holders of fixed income assets, retirees on fixed incomes, and anyone with savings in dollars. Inflation also risks becoming entrenched and difficult to control, potentially accelerating to higher levels that destroy economic function. The fifth option is outright default or restructuring. The U.S. could announce it will not honor debt obligations in full, forcing creditors to accept reduced payments. This is politically and economically extreme. It would destroy the dollar's reserve currency status, trigger global financial crisis, raise future U.S. borrowing costs dramatically, and likely cause severe depression. For these reasons, outright default is considered the option of last resort, used only when all others have failed or been exhausted. But historically, nations do default when debt becomes truly unpayable. The U.S. defaulted on gold obligations in 1933 when it prohibited gold ownership and devalued the dollar relative to gold. A future default might take the form of forced bond exchanges at below par value, or extension of maturities without bondholder consent, or simply printing money to pay obligations and accepting the resulting hyperinflation. The most likely path, based on political economy and historical patterns, is a combination of modest inflation, continued deficits, and eventual Federal Reserve intervention when fiscal stress becomes acute. The government will likely continue running deficits of $1.5 to $2 trillion annually, allowing debt to grow to $40 trillion or beyond. Interest expense will rise toward $1.5 trillion. At some point, perhaps when interest exceeds $1.5 trillion and consumes 25% of revenue, or when an auction fails, or when foreign buyers strike, the pressure will force the Fed to intervene with renewed QE or yield caps to suppress borrowing costs. This will create inflation in the 5 to 7% range, eroding real debt value over time, but also destroying purchasing power for citizens. The adjustment will be slow, painful, and involve a decade or more of diminished living standards, as inflation outpaces wage growth and savings lose value. The consequence for global reserve currency status is gradual erosion rather than sudden collapse. Foreign central banks are already diversifying away from dollars incrementally, reducing from 58% to 56% of reserves over several years. If the U.S. implements financial repression or sustained inflation to manage debt, the diversification will accelerate. The dollar will retain significant reserve role because no alternative can immediately replace it. The euro has its own fiscal problems. The yuan is not fully convertible. Gold cannot serve modern transaction needs. But the dollar's dominance will diminish from near monopoly to first among equals, with euros, yuan, and possibly IMF special drawing rights or other alternatives gaining share. The transition could take 20 to 30 years, but appears underway. The consequence for American power projection is that fiscal constraints will increasingly limit military options. A government paying $1.5 trillion in interest, approaching the entire Social Security budget, will face pressure to reduce other spending, including defense. Cutting defense from $874 billion to $700 billion would save $174 billion, but would require force structure reductions, base closures, deferred modernization, and reduced global presence. Rivals will exploit the retrenchment, China increasing influence in Pacific, Russia in Europe and Middle East, regional powers filling vacuums. The fiscal military trade-off that constrained all prior empires is now constraining the United States. In 1988, the United States government paid $214 billion in interest on debt while spending $290 billion on defense. The military cost more to maintain than the debt cost to service. The country could defend itself and still had fiscal capacity remaining. The ratio of interest to defense was 74%, manageable, sustainable, normal for a functioning government. In fiscal 2025, the United States will pay $1.143 trillion in interest on accumulated debt while spending $874 billion on defense. Interest exceeds defense by 30%. Before the government funds a single soldier, ship, aircraft, or weapons system, before it provides veterans benefits or maintains the nuclear deterrent, it must first pay over $1.1 trillion to creditors who lent money for past spending. The priority has inverted. Servicing past obligations now exceeds maintaining current security. This crossing point has occurred before in history, but only in nations approaching fiscal exhaustion and crisis. Habsburg Spain crossed it before serial defaults through the 16th and 17th centuries. Britain crossed it after the Napoleonic Wars and required a century of surpluses and growth to recover. Italy crossed it in the 1990s and required harsh austerity plus ECB intervention to avoid default. Greece crossed it before depression and bailouts. The pattern is consistent. When debt service exceeds defense, it signals accumulated obligations have reached levels that constrain core government functions, indicating approaching crisis requiring dramatic policy response. The United States is not yet in crisis by the metrics visible in Italy or Greece. Bond yields remain below 5%, auctions still clear, and the economy is not contracting. But the crossing point itself is a signal that fiscal dynamics have deteriorated to unsustainable configurations. Interest expense has doubled in 4 years from $540 billion to $143 trillion, and will continue rising toward $1.5 trillion as old low-rate debt matures and refinances at current market rates. Defense spending cannot grow proportionally without dramatic budget consequences. The gap will widen. The resolution paths are known from history: growth that outpaces debt accumulation, fiscal consolidation through austerity, financial repression that erodes real debt value, inflation that destroys purchasing power, or default that eliminates nominal obligations. Each involves substantial pain distributed across different constituencies. Growth requires reforms no political coalition supports. Austerity requires cuts no constituency will accept. Financial repression destroys savers. Inflation destroys currency value. Default destroys credibility. No painless option exists. The signals suggest the chosen path will be the least politically painful in the short term. Continued deficits, eventual Federal Reserve intervention when stress becomes acute. Sustained inflation of 5 to 7% eroding real debt value over a decade, and gradual loss of reserve currency dominance as foreign holders diversify. This path avoids immediate crisis, but ensures chronic economic underperformance. As inflation exceeds growth, living standards stagnate, and fiscal capacity remains constrained by interest expense consuming ever larger shares of revenue. The number that just broke, interest expense exceeding defense spending for the first time in peacetime, is not merely a budget line crossing. It is a signal that the fiscal configuration has reached a point historically associated with approaching systemic stress. The time between crossing this threshold in either crisis or dramatic policy adjustment has ranged from immediate in cases like Greece to decades in cases like Britain. For the United States, the lag is likely measured in years rather than decades, given the rate of deterioration, debt levels, and political constraints on adjustment. The pattern is clear. The numbers are observable. The consequences are historical. What remains is determining how long the current configuration persists before forcing resolution, and which resolution mechanism, growth, austerity, repression, inflation, or default, ultimately prevails. The crossing point where interest exceeds defense marks the beginning of that determination, not the end.